Hi, my name is Alex Carlucci with GustanShow.com. I want to talk to you about what lower rates does for our economy, specifically what it does for home prices and refinancing. Well, low rates means that the consumer pays less money for everything. Cars, houses, credit cards, all towards personal loans, business loans, all the debt is cheaper, so there's more cash flow in the economy, so it stimulates the economy. It gives more cash into the economy. What it does hurt is people want to save money on investments, on really safe investments like a CD or savings account. You get paid less, but it really boosts the economy. It puts more cash out there into the economy. And what that does is the reason when you have lower rates, it can cause prices of homes to appreciate because more people now qualify for that home than did last week. So now rates drop 0.5%, and everybody who qualified for $300,000, and that was their max qualification, may now qualify for $320,000, $325,000, and that will cause an appreciation in the housing market and values. And the same is vice versa. Lower or higher rates will hurt the value of homes, especially in that area from like 100 to 300. That's the sweet spot where everybody's buying. Now, the $1 million home isn't going to move so much on the higher rates and low rates because it's not as sensitive. It's a smaller pool of people, and they're not as sensitive as we are. It will hurt it, but that $100,000 to $300,000 range is a very sensitive area to rates, and it will move accordingly. So that's one thing. So when it comes to lower rates, people can refinance and save money, or they can refinance and get cash out. Both of those boost the economy because it puts more cash in people's pocket. Either A, from refinancing and saving. Just $100 a month is $36,000 over 30 years. If you refinance right away after buying the house, if you refinance 5 years into it, you're not going to save $36,000. You may only save $20,000 because the $100 a month is for 30 years, but you've already lived there for 5, so you're starting over. So there's a little bit of a loss there. So you got to call me for that one. I'll explain that one to you. It's a little more complicated to explain on this video. But if you refinance a house for the cost of $2,000 in closing costs to save $30,000 over 30 years, why not do it? Why give the bank the money? Don't just sit back and not do something. Refinance and save money. If you're going to save money, you do it. That's the bottom line, because why let the bank sit there and keep the money? So when the rates get lower like they are today, you definitely should capitalize them. Now, if you are in a really low rate and you're 3.5%, and you've been there for a while, but you need cash out and you have to take a 4%. Now you have to really decide, do I want to refinance my whole home, get the cash out? How important is that cash? Because now your payment's going to go up, but you're not going to have that cash to do whatever you need to do. If it's going to increase the value of your home by rehabbing it, that's a great decision. If you're going to pay off credit card debts at 20% interest rate and reduce your monthly obligations in total, then it's a great thing to do. So taking a cash out with lower rates, even though it's not as good as the rate you have from 5 years ago, you're still going to get your overall debt down, or you're going to increase your asset values by increasing the value of your home. So lower rates is good for our economy all around. It boosts furniture sales, it boosts refrigerator sales, washer and dryers, wood, lumber, the people redoing their floors, painters. It just boosts the whole economy. Everybody's landscapers. I mean, it goes all around. So the lower rates are, the better our economy is going to move along. And you're saying, why don't we just keep rates low forever? Because the downside to keeping rates low forever is there becomes inflation. We don't have inflation in our economy right now. The inflation would cause prices of goods to go up and go up and go up until you lose all the value of having the lower rates. So inflation is what the problem is with low rates forever. So that's what the Fed's job is, to manage that. So I hope you understand all that. If you don't, go to GustanShow.com, read our blogs on this, or just give me a call. I love talking about the Fed. I used to be a bond trader, so I know a lot about the Fed and how rates affect the economy. So give me a call at 630-915-7550, or go to GustanShow.com, GUSTANCHO.com.